Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Alrighty, we are ready to get started here today. How is everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding Podcast, sitting alongside my co-founder, Mr. Geoff Gannon. Geoff, how are you doing, man?
I am doing great, Andrew. How are you doing?
I am doing fantastic. We hope everyone is having a great week, has had a great start to the new year. If you do want to get access to Geoff's weekly memo, that is not going to go out on Wednesdays, and we're going to talk a little bit more about that later on. Okay. But it's going to go out on Wednesday, and it also comes with something that we're actually going to talk about here today in the podcast, which is your research pipeline. Our research pipeline for
the premium members.
For the premium members,
right.
That's correct. If you do want to get access to that and you do want to sign up, use the podcast promo code, which is podcast, and that takes $10 off of the subscription price, and definitely as long as you do stay a member.
Right, so that makes you a premium member, and then you'll get the watch list that we'll talk about.
Yep, that's correct. Yeah. And if you do want to follow me on Twitter, I tweet out a bunch of content and all stuff related to that. Feel free to follow me at Focused Compound. Geoff no longer is on Twitter.
That's correct.
That is correct. Okay, cool. So today, like I talked about, we're going to be going over our research pipeline, which is just something that you came up with for premium members, and a lot of people actually liked it a lot. So I thought that was cool. I don't know, you're not on Twitter, so you probably didn't see. I tweeted it out, but I blocked out what it was, or like all the tickers and everything. All right. So people were guessing. People were like, I bet you I could guess how. All right. Or someone said, don't you think people can guess the stocks because you tweeted out? And I said, I don't know, try guessing. And they guessed a couple of them. I'm like, no, you're not even in the same ballpark. Okay. So I thought that was kind of funny. But so we are going to be going over that, and I think it'll be good just so people could kind of understand. I mean, they're going to see what we're researching currently. Right. And then B, also, if they do become a premium member, which you get access to because people like it. So
this is from last week.
Yeah.
And the idea here is that this went out, and premium members get access to a write-up that week. So each week I do a write-up, and this watch list gives them a preview of what might be coming up in the weeks ahead. Might not, though. It will change because, as we'll see, this is a list with quite a few names on it, and as prices change and things I do change around what's there, although the ones at the top are almost certain to be the next things I do write about. Yeah,
it's almost like our batting order, I guess you could say.
Exactly.
Where, as things get more interesting, they move up or down in, what we see research. So, I think what I'll do is I'll just say the first stock, and then we could kind of talk about it. There's a couple stocks that we went over last time when we did the Geoff initial interest post, when we talked a little bit about that, but we could also just kind of just give the highlight of that and just reference the last podcast.
Right, and we talked about what reports are on the website, and some of these might be ones that have to do with a report that I wrote in the past, things like that. So there might be some connection there.
And it's interesting, too, because we actually haven't talked about this in a while, but a lot of these companies that we're researching now are businesses that we've researched in the past.
Right.
And we always talk about how that's good to do, especially in investing, because as you become familiar with the company, and then maybe Mr. Market gives you an opportunity to buy it, now it's a lot more interesting. It could be more interesting today than when you looked at it some odd time ago.
Yeah, and on the watch list, the actual watch list has the date that I added and stuff like that on it, and some information about the price today versus when I put it on the watch list.
Cool. Yeah. So I'm going to be going over the domestic watch list. This one, we have a bunch of domestic stocks, and then we also have we have one on the foreign watch list, and then we have a revisit watch list.
Yeah, so you should mention what that is. So that's because I do 3 different kinds of posts. Yeah. So an initial interest post, actually 2 different kinds of posts. An initial interest post and a revisit of an idea that I've already written about before. And also the reason why there's a foreign list, which doesn't have much of anything on it as of last week, is because I'm trying to as much as possible, get a good mix of foreign and domestic things. Yeah. I'm spending more time looking for foreign things. It's been harder for me to have as many good ideas from foreign things because I know U.S. microcap is better.
Cool. So the first company for the research order, which is the first sell, was Green Brick Partners. And we talked about this last week. We got a little bit more in depth on it on the last podcast, and we talked about, I guess, the history of the company. And it was a reverse merger, and they're a home builder here in Dallas, Atlanta, Colorado, and also Florida now.
Yes, that's true.
And we revisited. You wrote about it, or the price when this came out was $8.06.
Okay.
You originally said the price added was $9.49, and then the date that we added it, which is when you originally wrote about it, correct?
Okay. No, I wrote about it last week as of the time that you're listening to this.
Yeah.
So about a week and a half ago now. So the price will have been about the price that you see there. So what is it, $8?
$8.06.
That's where I wrote about it. I added it to the watch list before then. I've been keeping the watch list for a little while before we went public with it.
Okay.
Yeah.
Cool. Anything to say on the company?
No, not anything new, except I should bring up here that most of these stocks, the reason why they're on the watch list is because we do the managed accounts. Yes. The managed accounts have specific things about overlooked stocks. So one of the questions that I ask when looking for something to write up is it overlooked and why? Mm-hmm. So Green Brick is not a particularly big home builder, and it has the history with it being a reverse merger. Mm-hmm. So it maybe is more overlooked than some home builders. Mm-hmm. It's probably not the first home builder you think of. I would say that's probably true. Some value investors might know about it because of David Einhorn, but even then, I don't know. I mean, people see his portfolio, so they should know about it, but I don't hear it talked about as much as some of his other positions.
No, it's a smaller company.
It is, although he has a really big holding in it, so it's not a small part of his portfolio, actually. Mm-hmm. Yeah.
Cool. Next one that you had was BWX Technologies, which is a company we've talked about extensively
we have.
On this podcast because you wrote about it and there's a report on the website about it and you've written a ton of write-ups about it. Ticker BWXT. The price when we added this was $39.79.
It's close to that now.
Yep. And when you originally added it back in, it looks like 11/17/2018, it was around $44.85. Right. So it's a little bit lower than that, which is why it's back on your it's probably high up on your radar. Yeah.
Yes. So it is high. And that's because so for people who may not know the history here, I owned this stock and wrote it up when I did Singular Diligence. That's why there's a whole report about it on the website that if you're a premium member, you can read. And that's from several years ago when they did the spinoff, which broke it up into BW, Babcock & Wilcox Enterprises, which is very probably on the verge of bankruptcy, very close to that. It's like a penny stock now. And BWX Technologies. BWX Technologies went on to be more valuable stock than when the two parts were together. So by splitting off the market valued part of the business a lot higher than it valued the two parts together. It probably ran up to the 60s in terms of the stock price.
Yeah.
And then it came down to 40 or below on some issues like missile tube issues, which I think we got asked about in some Q&A recently. Yeah.
Yep. Yeah. And obviously it's good because we always talk about the four things that we go over. Do I understand the business? Is it safe? Is it good? And is it cheap?
Yes. And actually for this week, I'm adding a fifth one to that.
Oh, yeah. What is that?
So is it overlooked?
Okay.
So I will actually be talking in the memo that goes out today. As today when you're listening to this, not today when we're recording it, that I've been trying to score the watch list to get an idea of how to rank it more objectively. And it's those 5 things. And I've been assigning it a -1 for the answer is no, 0 for maybe, and +1 for yes. And then just adding them up. So the question's really, is it overlooked?
Yeah.
Right?
And let's define overlooked. The way we categorize overlooked in the managed accounts is spinoffs, illiquid stocks, microcaps, illiquid microcaps, stocks emerging from bankruptcy, nets, stocks trading below net cash, just a subset of stocks that, again, it's a name, tend to get overlooked for various reasons.
Right, exactly.
I mean, it's so like Apple is not an overlooked stock. We've talked about in the past, and people have asked us before, back when Berkshire was trading, I think it was trading close to book value, right? And it could have been maybe, I don't know what the stock's done since, but it probably was at the, could have been cheaper. And somebody asked us, well, would you ever consider buying Berkshire Hathaway? And we said, well, no, because it's not an overlooked stock.
Yeah, we would not do it for the managed accounts.
Yeah.
I did own Berkshire Hathaway myself in very early 2009. But that's a good example because the only time I've owned stocks that big and things like that are like a panic type situation, I guess you could say. So BWX Technologies does meet that requirement because it was a spinoff, or it's the remaining part of a spinoff. We count both parts as potential. Like we talk about NACO sometimes, and NACO is actually the remaining part. Hamilton Beach was the part that was spun off, but NACO is at least as people don't pay as much attention to it as Hamilton Beach. It's at least as overlooked. So BWX Technologies, I would say, does meet that because it was the remaining part of a spinoff, but I would grade it as being not overlooked because it's a several $billion type company.
Yeah.
I'd say it's well known now, although I don't think it was well known really at the time of that spinoff.
Mm-hmm.
Yeah.
So you think that you are going to?
So you can go over the other. Yeah. So how do I know it? Those sorts of ones. So what were the other? The other four.
What's that?
The other four questions that I look at.
Do you understand it?
Yes.
Which obviously you do. Is it safe?
Yes.
Why do you say it's safe? And they're long-term contracts. We've talked about this pretty extensively.
Yeah, so I'd say it's safe for a bunch of reasons. So actually, I believe that its bonds are not rated investment grade because it has a lot of debt. I don't consider it dangerous, though.
And it's the type of company you could probably lever up.
Right. I think I'm right about that they're not actually rated investment grade because they have a sort of standard way of doing that. I mean, they consider some other things, but just the level of leverage and the diversification is one of their tests, and obviously they're not a very diversified company. Mm-hmm. But I would consider it that way because it's the sole supplier for key components for the U.S. Navy for both submarines and aircraft carriers. Mm-hmm. And the Navy has long-term planning. In real terms, it plans it. And it has no intention of not continuing those programs.
Yeah.
So I think in terms of visibility, it has the best visibility of any company I know of.
Is it good?
Yes.
Which we kind of just said.
It has incredibly high returns on capital. Although it has to do incremental returns on capital, who knows? Because it has to buy other things or do something else because, we know what the plan is for the number of submarines and aircraft carriers. Yeah.
And then is it cheap?
No. But it's not too expensive anymore. It's potential to think about it. It's a stock that should probably trade at a premium to other stocks. Mm-hmm. And it's getting close to the point where, at least compared to other stocks today, it's not really especially expensive. Mm-hmm. So it's not priced above other blue chips and things like that.
Sure.
So that's the reason why it appears on the list, whereas for a couple of years, although I talked about the business here, I never talked about it as being a stock you'd want to buy because it's $60-some a share. I thought it was too expensive.
Mm-hmm. And the fifth one, obviously, we talked about overlooked, which you said you don't think it's overlooked.
Correct. I don't think it's overlooked.
Not today.
Yeah, and that's by my standards. I know that some people listening to this are like, I've never heard of BWX Technologies or something, but I mean, compared to some of the things we'll be talking about, I don't consider it overlooked. No.
And again, for the first four, for everybody listening, if you want to add this to your own sort of, I guess, filters, the first one is, do you understand the business?
Right.
The second one is it safe? The third one is it a good company? The fourth one is it cheap? Obviously, do you understand the company? Do you understand the business? If you don't understand it, probably, that's not something that you want to. And again, though, but I think a lot of people think really hard into that, right? Do you understand how nuclear reactors and really, I guess, like the chemistry that goes into it?
It's the economics of it that matters.
Exactly. Yeah. So you understand the economics of it and, how they produce cash flow, et cetera, right? Is it safe?
Right, exactly.
Is the company going to, go out of business? And in this case, for example, they have long-term contracts.
Yes.
It's and other factors that make it more of a safe business.
And there's no one else that produces for the U.S. Navy, there's no one else that will produce the nuclear reactors.
Yes.
The other parts of their business, there are sometimes other people who will do it. Mm-hmm. But that's the one that... The truth is, like with the bonds or something, no matter what happens with this company, even if it was in a situation where the common stock is wiped out or the bondholders don't get paid off 100% or something, the U.S. government will not allow this company to be liquidated ever. Yeah. So this company will exist in some form producing this for the Navy. Mm-hmm. So the only risks that they have are things that they could do something wrong, that there are lawsuits because this involves nuclear. And obviously, there's financial things if they diversify, if they go into other stuff and use a lot of debt to do it.
Sure.
Obviously.
Yeah. And then, is it cheap? Which we also talked about.
And I'd say it's not cheap. But what I mean by cheap is all of these I mean like on the surface, because this is before you even look at it. This is my checklist for before you look, really. Yeah. And it's my checklist for talking about it in my initial interest.
Yeah.
So when we talk about like, do I understand it? It's, do I understand the industry? Of course, I haven't read about this company in detail usually yet because it's my first time looking at it. That's what the write-up's about. Mm-hmm. But do I understand the industry? Can I learn about it? Things like that.
Yeah. Mm-hmm.
And so what are the first signs of that? Is it cheap? Usually means like on the surface, is it cheap?
Yeah.
So if it's at 15 times EBITDA, I don't know a lot. For some company, that might be cheap.
Yeah.
But I can't know that before doing a lot of research.
Sure. And I skipped one. Is it good?
Okay.
And which we define is, does the company earn high returns on capital,
right.
et cetera?
Yeah.
Every single definition read of a good company. And
a good example of that, another, like, is it good, is there's a book, I forget what the old one was called, but the one that was like 100 to 1 in the stock market or whatever.
Yeah. That's a good book.
And Babcock & Wilcox is in that. So that's another test. So for people who, like, sometimes you can't find data on, like, for instance, Babcock had a spinoff from McDermott back in, I don't remember if it was 2010 or something like that, because McDermott did like a tax inversion thing, which made it violate certain rules for the U.S. so that they couldn't be a, like, defense contractor the way that Babcock is, and yet not be taxed in the U.S. So because of that, they spun off from that. So, like, it didn't have a long history that I could see of the exact company, but I could find things about the company in its form going back a long time. And that's something you can do as a check always, is get the longest term stock chart you can find, right? And see if over the last 30 years or something, this is a stock that's gone up 100 to 1.
Yeah, sure.
That's the same as it was. That's lower. And sometimes there's a good explanation that doesn't have to do with the business they're in now. But if it's been doing the same thing for 30 years and the stock's gone nowhere, then it's not a good business.
And when we talk about does the stock work geometrically over time, that's kind of like a good way to do it.
Yeah.
And I'm looking, I have it right back over there, 100 to 1 in the stock market. That's a good book.
Yeah, so it does appear there. I think it appeared in the 70s. Yeah. I don't remember exactly.
Yeah, so there's an old book, and then, so that's 100 Baggers, I think, over there, which
so
is a new one.
Yeah,
and then the old, which was written off of the old one. The guy was, like, inspired by it a long time ago. So both good books.
Yeah. And I think, I don't remember off the top of my head, but I think that by the 70s, Babcock was 100 to 1.
Yeah.
So you could have made 100 times your money if you had held it through to the 1970s.
Crazy. And one last point I want to hit on this for people to add this to their filter. So do you understand the business? Is it safe? Is it good? Is it cheap? If you don't understand the business, the last three, it makes no sense, obviously, to go. Right. That they're ranked in that order for a reason.
They're in that order.
If it's not safe for number 2, you probably don't want to think, is it good or is it cheap? And if it's not good, then it's not cheap. You're not going to buy it.
Yeah, and overlooked is a good one to do last, to consider sort of almost. Sometimes people talk about, like, what do I know that the market doesn't know, or something like that. It is a good question to ask, sort of, whether you're looking at a cyclical company or something. After you've answered those questions, it is the last thing to ask of, like, well, why is it priced this way or something? I guess you could think about it. Yeah.
Cool. Next one's Front Door, ticker FTDR. Today's price, or when we put this out, was $27.74, and we started following it when it was around $23.04.
Yeah, and I should say that's when we started the watch list. So some of these companies obviously knew long before. Front Door knew before, So Front Door's a spinoff
with
from Servicemaster.
Yep, Servicemaster, which is termites.
Right.
Everyone knows those green trucks.
Yeah. So, and Front Door is a home warranty, a home repair business, and I did research on a company in the UK which has some similarities to it. That's called Home Serve, and I researched that quite a bit. It was one of the first singular diligence reports I did, so that's going back to 2013 or something, and that stock performed well after I wrote about it. So I had some awareness of, like, the attractive aspects of the business. And actually, did you look at Front Door at all?
Yeah,
we talked about it. Yeah, yeah.
Yes.
So, I like the business model a lot. This is probably a leader in the what it does, and it could probably grow to be really big. It has two parts of the business. So one is it has a home warranty for. So we're talking about, like, it covers something goes wrong with your water heater,
your
or something like that. Yeah, exactly.
Yeah.
And the business that isn't so great long term is when you sell your house and you buy a house. You get it as part of the deal with the realtor. It's sold through the real estate agent, because people don't tend to renew that one. But they're running ads and things to try to attract people directly to sign up, and those people renew at a nice high rate, so it works more like an insurance company.
Yeah. And which, renewal rates we've talked about before is if they have high renewal rates, that's a good sign of a good business.
Yeah.
And then, so is it safe?
I'd say yes, but although, again, I don't remember on this one if it's investment grade or not.
And then we talked about, is it good?
Yes.
And then, is it cheap?
That's the question.
Yeah.
I'm unclear if it's cheap or not right now. It actually dropped quite a bit after this spinoff. So I believe where it spun off, I thought it was not cheap, but it's now at a price that's below where I expected it to spin off. So
interesting. Next one, KLX Energy Services, another stock we've talked about a lot. Ticker KLXE. It was KLX Energy Services used to be a part of what was that company called? There's the aerospace company that got purchased by Boeing.
Oh yeah. So yeah.
I can't remember.
So KLXI. So
KLXI. Yeah,
so KLX Inc. KLXI was the ticker. Was a company, and it was itself a spinoff.
Yeah.
Previously, so it was the second sort of career for the CEO chairman.
I was gonna say
who's now gone with the spinoff.
Those guys are moneymakers.
Yeah,
I mean they've had a couple of very successful transactions.
Because that was BE Aerospace was the first business that he did. Yeah,
and they got that company got purchased by Boeing, and contingent on that happening, or not contingent on it happening, but part of the deal was they had to spin off KLX Energy.
Yep,
because they tried selling the business prior, and nobody made a purchase or an offer that they wanted.
Liked. Yeah. You can look into the details of the merger, background of the deal, or whatever it's called, background of the merger, on the SEC website for KLXI. We'll have it there.
Yeah,
and I think we've mentioned that before, but that's something I do that I've noticed a lot of people don't do. Whenever there's a deal, a sale of a company or something, always go in there and read about it. It's great for learning about peers, things like that, who offered what. It'll say things like company A, company B. It often won't name the companies specifically, although it will name Boeing. But it'll say how much they offered, why they offered it, things like that. Mm-hmm. And that was very interesting. In that case, the big thing that you get from reading about that is, one, the companies that thought that oil would turn up and that there'd be and were willing to pay a higher price, just didn't have access to capital, right? They didn't have clean balance sheets and couldn't borrow a lot of money. It sounds like energy companies to do the deal. And the other thing is that the companies that were energy companies didn't want to buy an aerospace company, obviously, and the aerospace companies didn't want to buy an energy company. So Boeing didn't want to. So yeah.
And this company, is it safe? I mean, came out with no debt at the time.
It did, and now it's loaded on debt. Yeah. So it's not safe now.
Yeah. I was going to say, I mean, when it was originally spun off, though, they had no debt. That was kind of like the big...
And $50 million of cash, and it wasn't going to pay taxes right away. It looked very safe.
Came out with, like, what, 4 times?
I mean, for a cyclical energy service, oil field services, this is more natural gas services.
Came out like 4 times EV to EBITDA.
Yeah, really low.
Yeah.
Yeah.
And they've announced since that they are going to lever up the company.
They did, yeah.
And the stock price was up like what, 20-something%
yeah,
one day?
On the earnings release, I think it rose 25%. I think it went from about $20 to $25 in one day.
On like positive guidance.
Yeah, they borrowed at a pretty high rate. I think they had bonds that would yield like 11 or 12% to do a deal, but it's a very good deal in terms of how cheap the company is that they're getting. We're talking very low EV to EBITDA, but it's now going to be levered up. Mm-hmm. And so, there's big upside in the company. It is cheap. You're going to ask that, and the answer is yes. Yeah. It is cheap.
Is it good?
Safe? No. Good? I don't know. Probably not.
Yeah.
So the reason for probably not is cyclical companies that are as cyclical as that, have a very, very hard time over an entire cycle having good, like we've said, geometric returns.
But which has also happened to the company in its history, right? They purchased a bunch of assets that were terrible, or it wasn't successful for them.
Yeah. So actually you can look, even some of the biggest oil field services companies, although they have high returns on equity during an oil boom, if you look back over 30 years or something, these generally are not stocks that perform really well because they have a few years where they actually lose money or generate almost no return.
Yeah. So the story sounded a lot better, probably. We liked it a lot more, obviously, when it had no debt and was trading a lot cheaper. Yeah,
I would say in terms of like an expected value, it might be better now than when we looked at it, but in terms of riskiness, it's a lot riskier now.
Yeah.
It's really, if you think that that kind of business, that providing those services, we're talking well completions and all sorts of different things they do, but that's a big part of the business. In the U.S., in the parts where they are in, which they're pretty diversified, so they're in a bunch of places that is sort of basically this is tied to fracking activity in the U.S. And if you think that's going to be really big for a while, then you could have, this could be a home run, sure, but it's risky now.
Yes.
But the management, the very top management, decided to go over to this company instead of retiring or something with the sale of the old company, and compensated in a direct stock.
It sounds like
just an equity grant.
From like You Can Be Stock Market Genius, it sounds like
a stock
exactly
that Joel Greenblatt would buy.
Yeah, what he would love.
100%.
So this is another stock that everyone's probably familiar with, Tandy Leather Factory. TLF.
Yes, I think we've mentioned Tandy on this show.
Yeah, a long time ago. Don't go listen to those old podcasts. Don't do it. I can't do it. Okay, so the price added when we added it to the watch list was $6.70, and today, or when this came out, was $5.76.
All right.
What do you like about Tandy? The chairman?
So the chairman.
Dear Chairman. He wrote the book, yes. Dear Chairman.
He did write the book, Dear Chairman. We're talking about Geoff Graham?
Jeff Graham.
Yeah. So he's the chairman.
I think he posts a lot of pictures of food.
On Twitter. That's all I remember is Twitter, yeah. So Tandy is a company. I've been to Tandy stores before. I've probably mentioned before that Tandy's history is it was tied up with Radio Shack. Basically, the Radio Shack idea came from Tandy. And Tandy is a leather crafting retail business. And they're laid out exactly like Radio Shack. That's why I keep mentioning Radio Shack, because people will know Radio Shack and have no idea what Tandy is. Yeah. So Radio Shack was a radio hobbyist for electronics, because that was a hobby in the 60s or 70s. And leather crafting is the same way. So the same term in terms of very few employees in the store, small store, manager who's compensated with the store's performance and things like that. Yeah, it's the dominant company in that industry, by far the biggest. It really created the industry. It has replaced the CEO recently, and I read the first comments from the new CEO.
What'd you think?
Pretty generic, what the ideas would be. They did mention things like rebuilding brand equity, which is kind of an admission that they haven't had success that way recently. It's interesting because the company has not had any real value creation recently, but it is cheap. It hasn't really paid out in terms of dividends or buybacks or something like that, and yet it also hasn't grown the value that's in the stock. So recently it hasn't really generated free cash flow that could pay out to give you a good return. And that's been a few years now after its growth period. So it had a long period where it had a lot of growth. And then the last, 5 years or something, it's had no growth. And certainly nothing it's done in 5 years has created value for shareholders. Yeah. But you have, like we said, a investor. He runs an investment fund who owns a very big part of the company. And it would be the person who could make a lot of decisions there. And it's, easily 10 times or more the size of any competitor. So it has a strong competitive position. I don't know about growth, things like that. It's very cheap, though. It's getting to the point where you should look at what net current assets are versus it, because it's going to get to the point pretty soon where it'll be net.
Got it. Next one, Servicemaster, which we kind of just hit on when we talked about front door. SERV, and the price added to the watch list was $42, and it's currently at $36.30.
Yeah, by far the biggest business now for Servicemaster is Terminix.
Yeah.
I did do some things where I read the annual reports of all the big pest control companies. There's some of the big other ones are not, well, they're in the U.S., but they're not publicly traded in the U.S. They're not headquartered in the U.S. So it's an interesting industry. It's a good industry. Terminix, actually, of all of them.
What's their big competitor? Don't they have a huge competitor that's publicly traded? Is that them?
Orkin? Rollins?
Rollins, that's what I was thinking.
Yeah,
it's
Rollins runs the Orkin brand.
Yeah, massive company, right?
Yeah. And they also have, what's the other one called? I don't know. It's a UK company that a huge part of its business is in the US. But the one that investors, I believe, would know best, US investors would know best, is the company is called Rollins, but the brand you would know is Orkin. Yeah. That's the brand that they own, and they're the biggest, whereas Terminix is smaller. However, Terminix is the biggest in termites, but much smaller in pest control generally. Yeah. And termites, generally, that business has lower renewal rates. Yeah.
So. Interesting. And do you think it's safe?
Yes.
Do you think it's good?
Yes.
Is it cheap?
No.
Probably not, because it's lower on the list. All right, next one, Garrett Motion, ticker GTX. We added it at $14.81, and it's currently trading at $11.70.
This was the other spinoff from Honeywell. So yes. I don't know if we talked too much about that. I probably just said it really in passing. But when Honeywell spun off Residual, they also spun off another company. So it's interesting, unusual for a company to break up that. I mean, not break up. The Honeywell that's left is still huge and much bigger than the two spinoffs.
Yep.
But it spun off two things at the same time, basically. Or it announced that it would spin them both off at the same time, and then went through with it. And so Garrett Motion, we can talk about. You can just go through the questions and you'll get a good idea why.
Do you understand the business?
That's the problem. No. So a huge part of their business is turbochargers, especially turbochargers for diesel vehicles in Europe.
Uh-huh.
So
you're not a car guy.
I'm not a car guy. I don't drive. I don't spend time in Europe, and diesel is not big in the U.S.
You hear that, guys? I pick him up. He doesn't drive.
That's true. Yeah. So no. I don't know it well. No. Mm-hmm. And there are issues with that. Like there's issues about what's the future of those things, regulatory things and stuff. I don't want to get into all the different things about diesel, and they say there's other kinds of cars will use turbochargers and why they would do that, and so they have all sorts of things about how they're going to be in electric cars, and they're but right now diesel is a really big part of the business, and it would be hard for me to know if the business in the future with changes in technology for that kind of stuff is the same. And the thing with diesel, just for people to know, is and there's a big divide has long been a big divide between North America and Europe on this. For carbon emissions, having diesel would be better. So if you want to meet certain requirements in your country, your company, whatever, about carbon, then so CO2 emissions, then you would want diesel. Mm-hmm. But the reason why it's not big in North America, because all the laws in North America that had to do with that stuff was about clean air in a community, not about global warming. That was the original concern about these things. And diesel does not give you clean air. Mm-hmm. Your city's going to be not as nice to breathe in if you use a lot of diesel. And, if you read about it and stuff, these companies will explain all sorts of reasons why the next generation of these things won't be like that and all those things. But that's what they would say, And so it's a sort of thing where you don't know if that technology will be as big in places, if there's reasons why it's the way it is now. And you could have a lot of electric cars and things like that. I don't know if, and these are really big, the customers are really big manufacturers that have a fair amount of bargaining power and stuff. So it's the kind of thing that's hard to research. Mm-hmm. It's pretty far up the chain of production in terms of like what we're talking about. We're talking about something that goes into a car that then is sold to people. It's about as far from like consumer goods and things like that are simple to research.
So why is that number 5 on the list?
It's has a good competitive position. Mm-hmm. It's not expensive, and it is quantitatively it looks good, and it also checks a lot of the boxes of sort of overlooked stock, spin-off, the thing people really aren't paying enough attention to. And to be honest, not a lot of people are excited either about Garrett or Residual. A lot of people were paying more attention to Honeywell after that. Mm-hmm. So yeah, that's why it's on the list.
All right, another next stock, Hamilton Beach Brands, a company that we've spoken about a lot also on the website, and there's been a bunch of reports on that. Ticker HBB, we added it at $23.28, and it's currently trading at $24.67. Mm-hmm. And this was the part that was spun off from NACCO Industries.
Correct. Yeah. So this is much simpler kitchen research.
Yeah, go look in your kitchen. I'm sure you got.
You probably do have something from Hamilton Beach or one of the brands that they have.
I bought a blender a couple weeks ago.
Yeah,
and a Hamilton Beach brand, and it's not that good.
It's not that good.
It's not as good as the Ninja that my dad has.
Yeah. So they're trying to get into some higher end things.
Yeah.
So go to Walmart or Amazon or something, and this will be one of the top options, one of the 2 or 3 top options in just about every kind of small appliance. Mm-hmm. Things that are priced $50 and under often. Your microwaves, your coffee makers, your toasters, your everything basically. And so it's easy enough to research.
Easy to understand.
Yeah, it's all made out in East Asia, and then earns pretty good returns on capital. Yep, it's a scale business, so I like their position in it. It has not grown much in real terms, and I mean, we talked about this in the podcast about it, and I know the two of us talked about it, but a big concern is that I'm pretty certain in the U.S. at least that over the last couple decades, the real price of these things has gone down. Mm-hmm. These things are actually cheaper. They're pretty flat pricing. Like if you remember what you paid for your toaster 20 years ago, it's probably not that different than what you could buy for toaster for today, but you're probably earning more money.
Sure.
So it's not keeping up with the overall economy that way.
Yeah.
And, that's a concern compared to some of the other stocks that we talk about. BWX Technologies will keep growing along with government spending, so.
Cars.com. This was a spinoff from Tegna. Man, we talked about this like 3 years ago in person.
Right.
As ticker CARS. We added it at $21 to the watch list at $21.89. It's currently trading at $22.33.
Yeah, so that's another spinoff followed by a spinoff.
Yes.
Like the Babcock one I talked about where it was McDermott, then Babcock, then BWX. Here we have, it was, what's the name that I'm looking for?
Tegna, right?
Tegna's the fake name for...
No, I don't remember what it was.
Okay, so the TV, anyway, newspapers and television. And then it spun off into Tegna, and then from Gannett.
There you go.
Gannett.
Yes.
So Gannett wanted to break up its different properties, and it had properties that were... So Gannett owns newspapers. This is going way back what Gannett had, but Gannett for a long time was a company that owned media properties, including local newspapers and TV. The market was valuing those things differently, putting a much higher value on local TV than it was on newspapers. And then also it had this business that was more of an online type business, Cars.com. And so the market would obviously put a much higher valuation on that than it would on a print newspaper.
Yes.
So you want to break those up, and they broke it up over a series of transactions where you split off the TV from the newspapers, and then you split off Cars.com. Interesting business. Actually, it reminds me a little bit of a stock I was looking at recently, National Cinemedia, which does... it's jointly owned by Regal, AMC, which is and Cinemark, and it does the pre-show. If you go to a movie...
Oh, really?
And you see the pre-show where they advertise stuff.
Yeah.
So it has the rights to sell that ad space.
Yeah.
So Cars.com reminds me of that because the way it was created originally is that it's, in a sense, its customers were newspapers who, in each of its areas, it ran the classified type things online for them. So its original papers were major papers in these markets, and so it was basically a classified car business online, and then it redid these deals with them, which is what made it interesting. Is when we were looking at it, saying, oh well, over time, now that they're independent of these companies, they'll be able to negotiate better deals.
Yeah, and I remember when we looked at it a couple of years ago, or when the spinoff was happening, Cars.com's it's a low capital expenditure, high free cash flow business, and we couldn't understand why their competitors were spending way more in capex than Cars.com was, if I remember correctly.
And that gets us to the issue for me with this company.
Yeah.
Which is, so Cars.com has several publicly traded competitors. One in the
Overseas,
UK, but they also have them in the US. And we're talking everything, you know what these companies are, Car Guru and Auto Trader, and there's a bunch of them that I'm not thinking of right now.
Yeah.
But you've seen a lot of ads for them.
There's one that went public too. I remember when we were
if you've watched cable TV in the middle of the day or whatever,
well.
this is just, you're seeing it all the time. And so that's my concern. Those companies are usually valued higher by the market than Cars.com. They're growing faster than Cars.com, but they're also earning much lower EBITDA. They're spending a lot more on marketing. Some of these companies are spending almost all their sales on marketing.
That's what I meant, marketing, not CapEx.
Yeah, on marketing. So, but they don't make more money. In fact, there's only one other company, and it's not in the U.S., that has similar economics to Cars.com. So all these others are trying to aggressively grow scale. They're acting like a .com type business, which they are. And so that's the concern there. But the business attractive economically, right? Good.
What was the big fund that was it Starboard? They owned took a position in the company as well,
that,
and it ran to like $28. Yeah.
So you had an activist there talking to people. I guess the feeling that we got is that they're the least growth oriented.
Yes.
Management and culture in general there, compared to any of the others. My concern there is just, intense, almost irrational competition, possibly, as everyone tries to grow to be the biggest and all that. So who knows? But, if the stock market doesn't do that well, if, venture capital and stuff isn't interested in funding these sorts of things, then you won't be able to spend incredible amounts of marketing and everything. Those sorts of things are all based on the idea of growing your sales really fast, getting an IPO, that sort of thing. So they're part of the reason there's so much competition is because recently there's been high valuations on websites, in terms of price to sales. So that was another thing, and that's continued for the last couple of years. So, there's just so much marketing spending by others. They're not the biggest spender on marketing. So there are other companies that spend more than them, even though they're quite a bit smaller.
Which is what worried us when we originally looked at it.
That is what worries me.
Yeah. Next one, Seritage Growth Properties. So, Mr. Warren B. owns this, and
he owns part of it.
Yep, that's correct.
Personally, I should say personally.
His personal
Berkshire's has loaned money to them.
Yes, recently, right?
In the last year,
SRG is the ticker. We added at $33.66, and it's trading at $34.17.
Yeah, and it's probably pretty close to, I don't remember Warren's cost basis in exactly, but I think it might have been around there.
Seritage was a spinoff.
Yes. A controversial spinoff because it's a spinoff from a now bankrupt company, Sears.
Yes.
Yeah. So Seritage was a spinoff of some good real estate that Sears had, and Sears continued to be a tenant for them. When it was spun off, Sears was their only tenant, really, and then over time, they would take back, or Sears would surrender to them, certain of the real estate where they would, vacate at Sears, and they would put in a new tenant. Sometimes they'd have to spend a lot to redevelop it or whatever, but the rents that they're getting from other people are all, in the beginning at least, and we'll see if this continues, 4 times or something the price per square foot they were getting from Sears. So the interesting part about it always was, is a Sears bankruptcy good or bad for them? And the answer is always, in the short term, it's very bad for them. But in the long term, it's good for them. They want eventually to get rid of Sears. So for the stock we're talking about here is basically, with Sears, you're talking about mall space.
Yes.
Space in malls. Sometimes it's a freestanding store, and sometimes it's attached to the mall, but it's basically in a mall location no matter what with these Sears ones that they have. So you can just think of it as mall real estate that they own. They're a landlord at malls. And it's Sears, so a lot of the real estate had not been invested in for a long time, well enough. And then they generally convert into other stuff. The ones that I know personally that I've seen that were Seritage ones were converted into like Dave & Buster's or a movie theater or restaurant or something like that usually. But a lot of them are just converted into other kinds of retail things that are bigger now. So, owned
so you understand
by Warren Buffett.
Do you think it's safe?
I do not think I understand it well enough. I don't. I think
because you don't understand the history. I mean, what it's going to look like in 5 or 10 years. You think, or what?
No, if they have enough capital, I think I know what it looks like in 5 or 10 years. But I think I don't know enough about mall real estate. Yeah.
So obviously that's why it's a lot lower. But do you think it's safe?
No.
That goes to probably the same thing.
And then, no, they need a lot of capital. So the issue is how quickly this is happening with Sears now, and they need a lot of capital. Now, this has always been the question that I've had with people, because when I talk with people in the past, and this is going back a year or two or more, we're talking about Seritage, they would say, well, they're going to be insolvent. Sears will go bankrupt. And some people thought Sears would go bankrupt faster than they did, and some people thought about when they did. They'll be insolvent. They won't be able to just pay for this redevelopment because they have all the redevelopment they're planning. It's just going to be where there's negative cash flow at some point. My point with that is, well, at some price it doesn't matter because someone with a lot of capital, people who own malls and things like that, would just buy the whole company or would lend them a lot of money or buy preferred shares or do something to recapitalize them for the properties, right? If the properties, like, this is not what the properties are worth, but say the properties were worth 10 times what the company's market cap was.
Okay.
Well, then some mall operators is going to buy them, or Berkshire Hathaway or someone is going to inject capital into them. So you have to try to do the math to figure out what the situation is. But you know how malls are changing now and what the situations are. I'm not a real estate investor generally.
Yeah.
So, those are the reasons why. It's an asset play. But it is similar to what other REITs and things Buffett has bought. If you look at all of Buffett's past real estate investments, they do follow the same pattern, and he's even talked about them a little bit, of buying something that has like below market rents that's going to raise those. So in 5 or 10 years, it's going to be generating a lot more income. Yeah. So, if you were going to buy into a real estate type situation, that seems the best to me. It seems like things that are always producing a lot of income right now are very highly valued by the market, but things that you're buying for their income in 5 years aren't so highly valued.
Tend to get overlooked, sure.
Yeah. And here you know that Buffett bought the stock personally, and you also know that Berkshire Hathaway loaned them money. So that's interesting too.
Is that a conflict of interest?
People have that question. It's a conflict of interest. Yeah.
I remember when they did that, people on Twitter were kind of going crazy. It's funny. So there's a Sears right down the road here.
Yeah.
In Plano, and they have like a sign on it that says like, yes, we're open.
Oh yeah? Do they? Yeah. Yeah. So anyway, so with Heritage, I would say, it's interesting. People should look at it, but, yeah, it's really far down my list. I have looked at it quite a bit in the past. I've looked at it a lot.
Yeah.
And you can look up where their sites are and what their redevelopment plans are and things like that. Some of the sites are good, but there's a lot of redevelopment planned. Sure. It's similar in that way but a more extreme case, but similar to we talked about Maui Land and Pineapple, where like what they want to, if they want to redevelop it themselves over the long term, they would have to put in as much money or more, a lot more,
to redevelop
than their market cap.
Yeah,
and same sort of thing with Heritage.
Untitled Technologies, the 9th one down the list.
Yeah, not much about this. It's just that it's planning to break up.
Spinoff, right?
Yeah, so spinoffs. And some...
Pershing's in it, Third Point's in it, Dan Loeb. Yeah.
And I know a couple of the businesses. So a couple of the businesses are in good industries and probably good companies. So they own a couple really old industrial businesses that are in some really interesting businesses. And so I'd be interested in those.
They were an elevator business?
Yeah. I'd be very interested in an elevator business.
Yeah. You've talked about elevators to me. I don't know if we talked about on the podcast in the past, but how they're like incredible businesses.
I like the elevator industry, especially U.S. elevator industry. So, yeah, I like elevators a lot.
Do you want to say why?
Why?
Yeah.
Oh, so elevators are, in the U.S. at least, this is how it's done. When a company installs an elevator for you, they make basically nothing. Like we're talking gross margins of 10% or something. Yeah. Then you have the operating margins. The company made nothing on the deal, basically.
Like razor and blade. Reminds me of helicopter hoist company, Breeze Eastern.
Yes, exactly, like Breeze Eastern. But the issue is once they make that sale, it's very, very rare in the U.S. for someone to use another elevator company to service that elevator. And that's true generally around the world, I think. That people stick with the one who installed in the first place, and that companies generally want the after-market business. But my feeling among the U.S. companies, and this might, among companies competing in the U.S., they're not all U.S. companies, is that this is an actual. They won't admit this, okay? But I think this is what they're doing. I think this is an actual competitive strategy, a known thing in the industry, that they do not aggressively try to take other people's business who've put the elevator in. They all want to retain the customers they already have. Because if you look in some other countries, that's not true, and there's some companies that are pretty aggressive at going after other people's elevators that they've installed, right? So, so it's a good business. And I live in a building where the elevators are constantly going down and people
lots of maintenance.
Lots of maintenance.
Sure.
But so yeah, that's a business that's good. There's other businesses too. There's one or two other ones that are interesting.
Yeah, but I know we'd be interested in learning a little bit more.
The reason that one's so far down the list, so that's planned, the spinoffs. The reason that's so far down the list though is that everyone will be looking at it, and those will all be big companies when they spin off.
Sure.
Yeah.
Last one domestically. Madison Square Garden, ticker MSG. We put it on the list at $266.32, and it's trading a little bit above at $268.48.
Yeah.
They spun off Madison Square Garden, or MSGN.
So it already split.
A while ago. That was like a couple years ago.
It already split. Isn't this interesting how so many companies like split once and then split again? Yeah, so it already split up into Madison Square Garden, the sports teams, and the arena, the site.
Yes.
And that business is separate from Madison Square Garden Network, the TV network. And I should say that I grew up and lived in the area where I've been to Madison Square Garden, watched Madison Square Garden Network, and know the sports teams that they own, obviously. Yeah.
Mm-hmm. So, so you understand the business,
family, which we'll get into.
You know the family?
I don't know them personally, but they ran Cablevision.
Yeah. So you understand the business. Is it safe?
Yeah, it's definitely safe.
Is it good?
No, but people are willing to pay for it anyway.
Yeah.
So no, I don't think sports teams are good enough. They own real estate in New York. Whatever. Yeah. It's okay. Mm-hmm. It's not bad.
Is it cheap?
Compared to what I think a buyer would pay if you auctioned off the parts separately, yes.
Okay.
Is it cheap compared to like what its EV to EBITDA would be or something like that? No, it won't be. Mm-hmm. But people will pay an absurd price for a sports franchise.
Now, what do you think about the owners? The family? Come on.
The family's okay.
Just give it to them. Give it to them.
The family, they're slowly trying to realize value here.
Yes.
Here's the thing about the family. The family, controlling family, controls Cablevision, controls now the different MSG parts. So the MSG network that we mentioned before, and now this, which we're hoping will spin off into, it's planned, will spin off into two parts, which will separate the Madison Square Garden, which is in the heart of New York City, from which is a venue, from the sports teams, which are like the Knicks and the Rangers, basically. So a major basketball team and maybe the most valuable basketball team. It's got to be close, and the hockey team too. The thing with their control owners. So the thing with them is they're not, now they're unlocking value, but they're never in a hurry to, report good earnings or to realize value now when you own a stock like that. Mm-hmm. They can always exit at a different point. Like I was looking at a stock recently, Arc Restaurants, which we've talked about before. That's always the issue there, because if the owner of that business, not the owner, but a major shareholder, founder, CEO wants to sell the company, he can always sell it at the going rate for restaurant EBITDA.
Sure.
So if the company's trading at 5 times EBITDA, but people will actually pay 10 times EBITDA for restaurants, whatever the market cap says, he can always sell it in its entirety, or when he wants to lose control of it, And the same thing here. So the stocks controlled by a family like this might do nothing for a really long time, and then they sell the entire franchise or something,
Got it. So that's the last one for domestic.
And that's definitely last on the list because it relies a lot on the value of professional sports teams, and I feel like it's the opposite of overlooked. Yeah. I feel like people have interest in this who aren't even interested in business things. I feel like everyone's done a presentation or whatever
because it's relatable to a lot of people. Yeah. I mean, it's on like every single message board there is out there. Mm-hmm. Okay, so the next one. So this is a company I'm actually not familiar with.
Okay.
And this is on our foreign watch list.
Okay.
Vertu Motors.
Yes.
And their ticker is VTU. They are out of London.
Yes.
We added it at $36.85.
Pence.
Pence, excuse me. You're right. And it's at $36.50 today. And I haven't done any work on this company, so help me understand
in theory, I might be writing out for the website this week.
Oh, in theory.
So when you hear this, premium members might have already read this or have this, not already read this, but it will be coming out the day you hear this podcast probably.
Sure.
So
what do they do?
So it was written up one time, not exactly this company, but the industry as a whole was written about on our idea exchange. Mm-hmm. Okay, so in 2017, I'm going to say.
So on the website, there's an idea exchange where if you're a member and you want to write up your ideas and kind of correspond back and forth with other members, you can write up an idea.
It's like a message board. It's like a forum for ideas. So about a particular stock. And so someone wrote up the idea of this company specifically, and the ticker is VTU in London. And I mentioned they trade in pence. So in the UK, the currency is British pounds, but they have a history of their stocks trading below a pound. So they tend to price theirs in pence. So even if a stock is 1,000 pence or something, it'll tend to be listed that way. Unlike the US, where stocks like penny stocks are kind of frowned on, right? So companies split and reverse split and stuff to try to get them up in dollars. UK companies get them down to pence. Mm-hmm. So it's a car dealership, bunch of car dealerships. Okay. 100 at this point, I think 103 car dealerships. They own about half the locations. Yeah,
we've talked about them not on the podcast, but you do like car dealerships as a business. Yeah.
Absolutely, yeah. And Buffett bought Van Tull, or
a massive one.
Yeah, in the U.S. And the write-up, which is a very good write-up that we have on the website, was mentioning that the UK recently, well, at least the last 10 years or so, has had economics of the car dealerships that are very similar to the publicly traded car dealers in the U.S., but they always trade at a discount in terms of price to book and stuff. So in the U.S., when you see people talk in the industry, when you look at sort of trade magazine stuff and reports about it, they talk about these dealers bought this and whatever, and they value it. What they do is they talk about the tangible assets, which is mostly land and the building and the cars. That's basically what makes up all that, with a lot of it being the locations, the original cost of building them out. And then the premium over that. And so when they talk about like what, how in real estate or something, they talk about like cap rates and things.
Sure.
What you'll see with car dealerships all the time is what's the premium over the tangible.
Yeah.
Exactly. Mm-hmm. But what's interesting in the UK is there's several of these that trade below tangible, which is not common in the US. And this is one company that trades below it.
Why is that? Because it's less followed, overlooked?
We don't know. Is the answer. I don't know why they trade at a different price in the UK than they do in the US. Mm-hmm. It's not supported by the economics of it. If you look at what their returns on equity are, what the growth in the stocks have been and stuff for the last 10 years or so, their economics are very similar to similarly sized businesses in the US, similarly sized car dealers. Car dealers make more money the bigger they are. They have pretty big increasing economies of scale. This particular company was created 12 years ago with the idea of consolidating the industry. Some things changed in the UK which allow consolidation. And the biggest companies in terms of market cap have, 3, 2, and maybe 1% of the market. That in the UK, and that's also true in the US. So there's a lot of room to buy up different dealerships, and that's what they've been doing, and that's what they do with most of the money they make is buy more dealerships. So
you think it's safe, and obviously you think it's a great business.
I think it's a good business. Mm-hmm. They don't use leverage, this particular company. They haven't really used leverage at all. And if you look at their increase in their net tangible asset value, how fast that's compounded. That's compounded at maybe 12 or 13% a year over the last 5 years. And then they've paid a dividend that's probably another 2% or so of net tangible asset value each year. Mm-hmm. So we're talking about a 15% return. Now, it's not quite reported earnings, but it's the actual amount that their book value is increasing plus the dividend. So it's very similar to like how Berkshire talks about their change in book value. That's how I'd look at it, right? Because if you can eventually sell these dealerships for some premium or discount to net tangible assets, then how fast net tangible assets are compounding is a good way of looking at it. In the early days, they didn't really grow that much, but now they have.
Because they reached that scale point or what?
Yeah, exactly. So I would say if they can grow at 10 or 15% in terms of net tangible asset value, and recently they can do that just by buying back the stock. And they bought back 5% or so of the company last year, and they might buy as much as 10% this year. They have permission to do so. If you do that, then obviously you grow net tangible asset value because you pay the market price for your stock, which is less than your tangible assets. So you grow it just by buying back stock when your stock trades below book value. Mm-hmm. So I'm very convinced they can grow net tangible assets. So let's say you get a 10% return on your net tangible assets.
Sure.
And since they were last 10 years or so, that's what they've gotten. Okay. And then, like I said, last 5 years or so, they've gotten even higher. And that might be because they have better scale, or it could be cyclical. So you would think if you buy at 1 times net tangible assets and they get a 10% return on net tangible assets, you're going to get a 10% return in the stock if you own it for a long term. So here, if you're buying at less than net tangible assets and they're getting a 10% or higher return, you should get a 10% or higher return in the stock. EV to EBITDA is low single digits. We're talking... these stocks at times have traded as low as 3 to 5 times EBITDA. EV to sales is low, and price to book is really low. So
that was a good pitch.
Yeah,
there you go, real action.
So, and I like their capital allocation stuff with this company right now, and they own half of the sites, so they have which in general are probably worth a little bit more than they carry them on the books for. So, and if they can buy back stock, the big thing is, will they really buy back stock with this? Will they really do a good job of allocating capital that way, where they only do acquisitions that make sense, and then when they don't have an acquisition that makes sense, they can buy back stock. There's also one other thing that's
Do they have a history of doing that?
Yeah. Well, only recently have they bought back stock. Early on, they did exactly the opposite.
Which makes sense if they were trying to consolidate the industry.
In the first few years of being a public company, they did a ton of acquisitions. Their number of shares outstanding went up a lot and stuff, but it hasn't at all in like the last 5 years. And I think it'll go down. And that's what really interests me about it is the price is low and everything. here is a time when they might start buying back a lot of stock. They did last year. I feel like they will this year. And they've been saying for a while that they and a lot of competitors have been investing a lot in modernizing their dealerships and stuff. And that this has been eating up free cash flow. And that next quarter, so they said at the end of March of this year, they'll reach a turning point where they won't be making that investment.
Sure.
So the most logical place for that is to go into buying back stock.
Yeah. Makes a lot of sense.
So
interesting.
That's So it seems like a company that's trading below book value in an industry where all the dealerships should go for book value or higher. So you have a discount to what I think a private owner would pay for it. And then what if they buy back more for you? They're sort of doubling down for you.
Sure.
You're getting, more of a return just that way.
Interesting. All right. Next part of the watch list is the revisit watch list. So do you want to explain what this part is?
Yeah. So this is stocks that I wrote about before, talked about before, and then we just look at it again. That's the idea.
Is there a reason why they're not on the domestic watch list?
Yes. In some way, I felt that I wrote about them before.
Okay. So it's just...
I don't count the reports that I did, which predate our website, and some of them are as old as, 5 or 6 years old now. Yeah. It's a judgment call. Some of these stocks have been written out by other people, and yet I still consider them to be an initial write-up by me. But for these that we're going to talk about, for whatever reason, I consider it that I've talked about them before.
Sure. Yeah. Okay. So Residual Technologies.
So that one.
REZI.
Yeah.
You added it at $21, and it's currently at $20.
Yeah. So that I wrote up on the website.
Yes.
Yeah. And in pretty big detail. So that one's definitely a revisit. So that right now that's the top of the list of stocks I would revisit. Stocks I've written up before that I would write up again. The biggest reason for writing up again is just the stock price declined a lot. So I wrote it up before the spinoff.
Yes.
And I had in mind a price that I thought it might spin off at or so. And it's probably at 2/3 of that now. So it got a lot cheaper. Yeah.
Is it a safe business?
Yeah. I mean, we talked a little bit about Residual before, I guess.
On the initial interest post.
Yeah. So, it's a spinoff from Honeywell. I think I talked a lot about like thermostats and businesses like that. I think it's safe. It has those environmental obligations.
Yes.
So that's the biggest thing. In terms of any danger to the financial future, it's those. The risks that have to do with risks that have to do with debt in general, but really specifically the environmental cleanup.
And do you think it's a good business? Who knows? We kind of talked about that before.
It is a good business. I don't know that it grows.
Yes.
Yeah. So when I talk about good businesses, that is something where if I think it's a good business, but I'm not sure it'll grow, that sort of gets I don't know if it's a good business or not, because it doesn't matter how high your returns were in the past. It only matters with new money that you're putting to work.
Yeah.
Right. So their gross margins, returns on capital, things like that are good. But if they don't grow at all, then what are they going to do?
Sure.
So you don't get those returns. Yeah.
And then is it cheap? Which you just referenced. It's came out 2/3 cheaper than what you thought it would come out at.
It's cheap compared to the S&P 500. Yeah.
Got it. And then the last one is Hostess brand warrants, ticker TWNKW, and we added them at $78 or 78 cents.
Yes.
And it's currently trending at $1.
Yes. So I should go over what these warrants are, because that part's a little confusing. So you need 2 of these warrants to get 1 share of stock.
Yes.
And the warrants expire, I'm going to say, is it the first week of November 2021?
Yeah, it's still a couple years out.
Yeah. So it's I think it's near the end of the year of 2021. But like we said, you need 2. So if we're saying the price is $1, then you would need you'd have to pay $2 to have enough warrants to get a share of stock. And that gives you a share of Hostess stock at $11.50
ish. Yeah, I could catch it. Look it up right now.
So no, I mean the exercise price is $11.50.
Yeah, it was.
Yeah.
I'm just kind of curious to what's trading right now.
And it has a cap that's about twice that. I forget if it's $23 or $24, but I mentioned on the blog one time.
It's currently trading at $11.37.
Yeah, so basically the right. So right now, you would be paying $2 to be able to buy the stock at pretty much today's price at any time between now and the end of 2021. Okay, so you're putting $2 down now instead of putting down $11.50 or whatever, to be able to profit the same way that someone in the stock would, except it is capped at about double today's value, so about 100% upside. So you'd be capturing that upside from 0 to 100%. You're risking $2 instead of risking $11 of your money, and all that stuff. That might not sound that great to people listening, except the capital structure of Hostess makes it more interesting. So the reason why the capital structure makes it more interesting is that Hostess has a lot of debt, and two parts about it. One, it has a lot of debt, so that makes the stock more volatile, potentially more volatile. It should make it more volatile. And a more volatile stock would be more interesting to own options in that way. And then the other thing is the danger of the downside is that Hostess stock may not be as safe as people think, because if it has a significant decrease in its revenue, earnings, etc., once there's concern about its ability to meet debt payments and things, the stock will really have a huge decline, and so you're not as well protected in the common stock versus the options as you might think. So the reasons for owning the common stock instead of the options are usually like the increase in safety and things like that.
Sure. And it's a very high, like you said, it's very highly levered. It's like 5 times debt to EBITDA.
Right.
It's definitely up there.
Yeah. So it's a very predictable business, but it has this high debt on top of it. And then the other thing about it is these are warrants, not options. So I'm saying this because most people who are listening to this, I would guess, who have any experience with these sorts of things would have experience with options, not warrants, right? Don't you think so?
Yeah.
Yeah. So what would happen here, and there's quite a lot of these out, is that if these warrants were to be profitable at some point for you buying it, that would also mean that the company would get quite a lot of cash when it was exercised. So all these people exercising would mean hundreds of millions of dollars of cash coming in, taking that net debt down. So the other part about it is when you do the math on it, you have to do the math of after the warrants are, assuming that you are looking at the upside here, right? Because you know what the downside is. A lot of people, it goes to zero.
Yeah, and a lot of people don't do that when they value the company from write-ups that I've seen.
Right, I know. And so you have to do that where you have to say, okay, so there'll be more shares outstanding. So you have to take that into account. But then you also have to take into account that the company will have paid down all this debt, or will have more cash, I should say, because everyone will have exercised these warrants. Because someone will own the warrants, and they will exercise them if they're worth something then.
Yeah.
At the end of 2021.
Do you think the stock is cheap? See, it's a tough one. I know. I mean, you understand the business. We've talked about it a lot.
I think the stock is very close to fairly valued right now if it doesn't grow market share. I think the company has historically increased the market share of the Hostess brands, the core brands that they have. So we're talking like Twinkies and things like that. Year after year, they've increased the market share. Now that category is shrinking or flat, but their own market share in it is going up and up. And if you go to, you can go to dollar stores and things, but if you go to Walmart or something like that, that's probably the easiest place to see it. You'll see that this is it's pretty close to a duopoly. There's really sort of 3 companies, but it's close to a duopoly in that McKee Foods, Little Debbie, and Hostess really control the shelf space. And some will be Bimbo, a Mexican company, which has some things, including owns Entenmann's and some stuff like that, and also has all the ethnic Mexican stuff that you'll see there too. But in general, all the sorts of things that you'll recognize in that area of it will be those 2 companies. So there was, I think, a lot of concern in the stock recently where Walmart shifted around what they were doing and stuff. Yeah.
Taking away some shelf space.
Yeah, and I've been to plenty of Walmarts looking at that, seeing what the differences are and everything. And I think that's overblown in terms of how analysts reacted to it in one sense, which is like long-term what it meant for the shelf space and things like that. But I think the analysts were reacting more to the fact that they gave them a lot of ideas about how bad the next quarter would be, which is true.
Yeah.
And they cared a lot about that. And that's absolutely true because you could see that Walmart was not going to be buying more inventory, not going to be buying much more inventory from them that next quarter. And so they're basically telling you 3 months ahead of time exactly how bad the next quarter was going to be.
Yeah, exactly.
Because Walmart would be trying to bring down their inventory levels and redo all these things. But now that you look at what's happened in terms of the actual shelf space, I don't feel like it's changed as much as you might think. There was some stuff they brought in because like Twinkies came back from a bankruptcy, and it was a brief sort of cultural phenomenon there, right?
Sure.
And so there's some of that stuff which I think will go away. Like they did some extensions of the Twinkie brand and stuff that I think will go away. Yeah.
I mean, the new business though is completely different than the pre-bankruptcy company.
Yeah,
they
absolutely.
employ like direct to, I forget the exact technical word, but they wouldn't. The distribution is completely different now.
Right. Yeah. Now they go directly to the customers. Yeah. To
Yeah.
the customer's warehouse. Yeah. Yeah. They don't have any of that previously.
Or pension liability that they did before.
Right.
Yeah.
They have far fewer sites. They increase the shelf life.
Before it was
of the
direct to
product.
store. That's what it was, direct to store, and now it's direct to warehouse. So instead of having to employ all these people to drive around the trucks and the trucking costs and fuel
and they were
costs, etc.
unionized. They
Yeah,
had unionized
exactly.
trucks, yeah.
Now they just go directly to the warehouse, so it's a much leaner distribution model. Which I think also Kellogg. I was reading a bunch of other companies are kind of doing that as well.
Yeah, it reminded me a lot of what I remember happened with Nabisco 20 years or so ago. Yeah, so it did seem similar to that. Yeah, and it has, and it's an interesting company because it has like mostly, you know, there are different food companies that have some good brands and some bad brands and things like that. This is a company that has good brands. That's all that it has is brands that people know and everything. It's a category I think you asked about on Twitter, like, would you let your kids eat this or something?
Yeah.
Something like that. And so it is controversial that way. This
Because
is
we're a more fit nation.
I guess so. It's interesting because if you look at actual behavior stuff,
Yeah.
mostly what you see is
Well, the Twinkies though that you're eating today is completely different than it was 20 years ago. I mean, even like post bankruptcy, they changed up the formula to give it more shelf space, and it's more. It's got more chemicals in it.
yeah, that is absolutely true. Yeah, there's long been a myth that like Twinkies last forever and stuff, which is not true to this day, and wasn't true at all before. They didn't have a particularly long shelf life compared to other things.
Yeah.
But it shows you how well known the brand is in the name, particularly of Twinkies.
Yeah.
But yeah, they did increase the shelf life, especially I think to sell to things like dollar stores and stuff, where you see a lot more of that in certain parts of the country. I have noticed that there's more and more of a division that way about where it's sold, I think, and things like that. I think it's one that everyone listening to this should look into. It's really easy to research. You can research the management and what they've done in the past and things like that. You can
Private equity guy, billionaire.
You can research like the strategy of what they're clear about what they want to do and all that. And you can just go to dollar stores and to convenience stores and to Walmart, and you can just be aware in your day-to-day life of it, looking at it. At what I just said about McKee Foods and Grupo Bimbo and all that, you can look now, flip over all the snack foods that you'd be looking at normally, see who sells what, how much shelf space they have, how much there's like directly a one-to-one of each, like they have their cupcakes version and the other company has their cupcakes version. They have their brownies and they have their brownies. Why is that? Why is that there, and what's the pricing and everything?
So just don't go grocery shopping with Geoff because you'll be there for 5 hours.
I just think we're talking about like Garrett Motion or something.
Yeah.
That's an incredibly hard thing for people to research and learn about and get scuttlebutt on.
Well, it's a lot easier if you could feel it and see it. I mean, you're familiar with the brands. Yeah.
There will be people listening to this who know people who work at Walmarts and dollar stores and things like that, who know things about the shelf space that they have and how these things come in and how it's distributed and stuff like that. There's lots of things that you'd be surprised that you can learn about those things. And there'll be very few people listening to this who can tell you a lot about Garrett Motion.
Sure. And because I know everybody's wondering, Geoff shops at Costco exclusively for groceries.
I am, yes. Yeah, probably 90 to 100% of my purchases are Costco and Amazon.
Yeah.
That's true.
That's good. That's good. Cool. Well, that's part of our research pipeline. And if you are a premium member, you get access to that every single week.
Yes.
And you also get access to a premium memo. If you want a free memo, which Geoff puts out a free and a premium one, you could sign up for the free one if you don't want to pay, but the premium memo is a little bit different.
Yeah, so you should say what that is. So with the memo, what you're getting is you just come to the site and you give us our email, you will get a memo which talks about a general investment.
Yeah, and then if you're a premium member, you get the watch list as well.
Yeah, you get the watch list as well, and you will get there will be a link in that each time you get that watch list, which will have what the write-up is for that week.
That's correct.
And it is Virtu Motors this time.
Oh, it is?
Yeah, I can reveal that to people.
So what is the premium, or what is the memo about? That's going to go out today.
The memo's about the watch list, and actually we talked about it's about how I order the watch list. So I said that I added something, is the stock overlooked? It's those 5 questions.
Got it.
And how I use that to order the list, basically.
Cool.
Because last week I did a memo about like how to create a watch list and stuff, and this week's memo is about how I personally am ordering the watch list.
Cool.
Yeah.
Well, I think that's a good place to stop. Thank you so much to everybody for tuning in. If you do want to support Geoff and myself, one way you can do it is give us a rating and a review.
Yes.
We hope you give us 5 stars. If you're not going to give us 5 stars, don't even rate us.
You can give us a bad review. Just give us 5 stars and then the bad review.
There we go. Because that helps spread the word for podcasts and through iTunes.
You're free to tell people about it too.
Yes.
Say, go on your iTunes and listen to the show.
Yes, that we will.
Or Apple Podcast. Is it called Apple Podcast?
Yeah, it's through Apple Podcasts. Okay. And we also have a podcast part on our website as well.
Yeah. That's true.
Some people listen through Podbean, which is where we host the podcast, and we have a lot of followers on there.
Yeah, we have there you could see the that'll have the the promo code and things like that there. Yeah,
and it's always in the show notes as well.
Yeah,
cool. Other than that, I have nothing else to add. You have anything else to add?
Nope.
If you want to get in touch with us, you can email me always at info@focuscompounding.com. Okay. Jeff's is gannononinvesting@gmail.com.
Yeah, and if you're listening to this, you can recommend for me, suggest, because I did get some suggestions that I added to this upcoming week's watch list. You can suggest to me stocks for the watch list, because you've heard this, what kind of stocks I'm interested in. The one thing is, if you send me an email about what stock you want me to add to a watch list that you'd like me to look into, tell me why it is overlooked in some way, basically. Tell me, is it a spin-off? Is it a microcap? Is it something? Why is this not Microsoft or Facebook or something like that? Yeah, that's the one thing. And then you can be a couple sentences, but, that'd be great.
Or you could also DM me on Twitter as well.
Okay.
At Focus Compound.
Yeah.
And we'll add that.
But don't just, if you just send me like a ticker, that unfortunately isn't, I won't know within 5 minutes of looking at the stock why you're telling me this is an interesting stock. So, when you do tell me what stock you want me to look into, tell me why everyone doesn't know about this.
Cool. Good. Alrighty. We hope everybody has a great week. We will see you next Wednesday. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.